The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, ladies and gentlemen, and welcome. It's Brian Rainier here. I'm the head of research for Merchant Tech, and just like to welcome you here today. As most of you know, we publish research on mid and small cap companies, and this is made available to Standard Bank online clients on their website. And you can download most of the research that we talk about, and webinar interviews that we bring to you are also available on the Standard Bank website. If you'd just like to give me a wave of your hands so that I can see that you can hear me. Okay. Great.
Yes.
Thanks very much. You may need to just adjust the volume a little bit on your computers, if you can put it up to max, because Mr. Ronny Katz is a little bit soft on the technology that he's using. But I'm glad that you can all hear me. So yeah, once again, welcome. One of the companies that we've recently initiated research on is Workforce Holdings, and today I'm joined by their CEO, Ronny Katz, and their financial director, Willy van Wyk, and they're going to be giving us a good introduction to the business and what it does, as well as take us through their latest interim results, which were released earlier this week. So welcome to Ronny and Willy.
Hi. Hi, Brian.
Hi. So by way of broad introduction, Workforce provides human capital solutions, and this includes employment and contracting services, training, solutions in the healthcare sector, as well as wellness, and a number of financial services and solutions to their employer and contract clients. They were founded in 1972, so been around for very many years. They employ around about 1,400 permanent employees, have an annual revenue of around about 3 billion, operating profits of around about 150 million, and have got a market cap of close on 400 million. The share price, as you can see, is trading at around about R1.60, which is at a significant discount to the NAV. And again, the published historic price earnings ratio is very, very significantly showing that there is huge value to be gained from what is a reasonably high growth story and a very well managed company. So it's definitely, like some of the other companies we've showcased to you, it's definitely a company worth looking at and looking through the cycle to see, a big unlock of value coming through. And as we've said, as a small cap investor, you do need to be patient, but you do also need to get in relatively early into these companies, because once the share price moves, it moves very quickly. So do your analysis, have a look at the fundamentals of the business, and hopefully by the end of today, you'll have a much better sense for what it is that they do and how well they're positioned. So I'm going to hand over to Ronny through a series of questions, and Ronny, to ask you if you could just give us a brief history of the group, which I assume you founded back in those days in 1972. If you can give us a broader overview of what you consider very important about what it is that you do today.
Right. Thank you, Brian, and thanks for that introduction. Looking at a brief history of the group, we started in '72. There was no staff outsourcing in those days. The concept we brought to the market was myself and one or two others. What we did at that stage was we imported skilled artisan staff from Germany, Portugal, and England for various projects in South Africa because the skills weren't here. As time went along, and one of the hallmarks was the Koeberg development, we found that more and more South African people were being trained in these various artisan skills, and so the need to import staff reduced, and we started specializing in the development of artisan and other skills throughout the country. The developments grew from Koeberg to the development of Sasol, and I could say that every major developmental project that the country has seen since '72, we have been part of it, and that has enabled us to grow, both in terms of the number of people that we employ and in terms of the technology that we bring to the client in regard to managing its staff. We listed in 2006, and those were the heady days. Share price went straight through the roof, and 2008 brought us right back from, I think it was then R1.50 a share down to 15 cents a share. That didn't last very long. The share price gradually crept back, and what we did in the meantime is we followed a philosophy of sticking to our knitting and developing a good sound business, because we feel that that's what is the backbone of any share price going forward. The company developed today, we've got 90 branches throughout the country. We operate in various different divisions, which I'll go into with you now. We employ on a daily basis approximately 35,000 people who we payroll every week. This is quite a major undertaking, and I'm pleased to say that all the technology that lies behind the payrolling and the management of the staff is all internally developed, and is a very large part of our internet IP. After our listing, we steadily started changing things, and during the early 2011, 2012, the muttering started on the labour broker. There was a question, does the labour broker fulfill a service, or is it just a way of getting cheap labour? And that was a struggle that we had, because we know ourselves that we provide a substantial service other than just providing the staff to the client. This culminated last year in a court decision by the Constitutional Court, which set down the rules for having permanent employment or temporary employment, and it kind of leveled the playing fields both for ourselves, for our clients, and for the trade unions. So we, each and every one of us, know exactly where we stand and where we can conduct our business. There has always been and always will be a need for temporary and fixed term staff. It's something that cannot be taken away. The economy as such cannot have permanently employed staff on a project that is there for a year or two. So we're confident that our model is a model that has a strong base and will go forward. We, during the period when there was the outcry against labour brokers, and that is probably one of the biggest overhangs on our share price, we then decided to develop other areas of our business, namely in staffing and training and financial services and healthcare, Each of those were products that we had developed to service our own stock outsourcing business, and we externalized them by turning them into independent business entities that acted directly into the market, even though not in support of our own stock outsourcing business. This culminated last year in us changing our organizational structure, whereby we formed an exco, and reporting to this exco were the 5 clusters: the staffing and outsourcing, the training, financial services, healthcare, and, as I'll mention later, Africa. These clusters, the intention is that in each one of them, it's an ambition of ours, is that each one of these clusters should become a self-sustaining business unit, making sufficient profit to be self-listable if we do want to list them, or if we don't want to, that's a different story. So giving a brief outline on those clusters, the staffing and outsourcing cluster, as I said, is a very vibrant business. It went through a hard time in the first 6 months due to certain changes, and also due to the current economic climate in the country. We went through electioning, we went through political change, and economic downturn. But notwithstanding all of that, the profitability did drop. But going forward, as you'll see later, we are very hopeful that this will normalize and growth in that segment will start. In the other segment, the training segment has become a very important segment for us. It contributed about 25% of group profits. It is made up of an internally developed business, training force, and a number of other entities which we have acquired over the last 2 years. And all in all, as a cluster, during the course of this year, we saw about a 45% growth, and we have ambitions to grow this much more substantially. This is run under the leadership of Stephen Herskovitz and his team, and we're very confident that they're doing a good job and that there's a lot of room for growth. The third cluster is our financial services cluster, run by Jonathan Kruger. It is involved in providing microlending and other financial services and product sales to our database of 35,000 people. The whole database is much larger than that, but we provide these services to the people that we're employing. In that cluster, we also started an insurance cluster, which deals with funeral and medical aid type insurance. We've had very successful developments there. It's cash generative, and we are currently doing the medical work for a number of companies, which I'll mention. We do for PEP, we do for Cape Union Mart, we successfully tendered for the post office, as well as our own, and we've also developed into Botswana, which I'll explain later. So that segment is doing well. It's also got a debt collection segment to it, where we do outsource debt collection on a very sophisticated technological base for different clients. One of the most exciting clusters for the future is our healthcare cluster. It deals with, we can segment it into wellness centers, also clinics. We've got approximately 75 operational clinics sitting within our clients' businesses. We have mobile clinics, and the purpose of these are really to ensure proper conformity to occupational healthcare services. Occupational healthcare today is obligatory. Companies don't really follow it, but it's getting more and more of a following. And because of the obligatory nature of it, we feel that there's a lot of growth for us in that segment. We also do frail care, the nursing services to frail care homes and to hospitals, which is an outsourced basis. And we're hopeful that, and we've got a number of plans to grow this healthcare division, because we feel that it really is something that can contribute substantially to the health and well-being of staff. And if you combine that with training, it's also an extra element in the staff. So all of these services become very material when you look at in a broad spectrum manner at how do we handle our staff and how do we look after them and care for them, etc. Part of our positioning line is that we don't only provide people. We are part of the solution to the employment problems of the country. We upskill people. We grow our business. People. We basis of profit for a profit with a purpose. We have a social well-being initiative, which is part of the fabric of our company.
And Ronny, is it true to say that most of these the divisions, so even training, financial services, and healthcare, how much of your services is into that that payrolled environment of yours of 35,000 people, and how much of that is solutions that you're taking into the broader market?
So I would say that the majority of the work that those outsourcing solutions provide are outside of our 35,000 people. They are too, and that's why I said we externalized it. Our client base there is very different to the client base that we have for our staffing and outsourcing segments. So whilst they do complement and we are able to cross-sell, they are each independent of the staffing and outsourcing business.
Okay.
Does that help you?
Yeah, great.
Yes. So I think also what's very important to mention is the way that these clusters work within part of our strategy, which we'll come to later, Brian, and that is in Africa. Each one of those services, staffing, outsourcing, training, particularly training in healthcare, are in great demand in the SADC countries and higher up. And we've, in the last year, we've embarked on an initiative where we can actually take these services into Africa. The IP is the same. The client base, very often we're following our clients from here, but we're also establishing new clients. And we're finding that we do have traction, and currently we're operating in Botswana, Namibia, Mozambique, Mauritius, and we're looking forward to a lot of growth coming from those areas.
Okay.
Okay.
Yeah.
Then, yes.
Yeah, carry on.
So if you want to go, if you want to talk about the differentiators that we have in all of these markets, I think our technology is a differentiator. The combination of the different skills in the different areas and the different clusters also is a differentiator. You know, we can take a staff member that a client wants to employ, for example, in the mines. We onboard the person, that's part of our training process. We do the medical services, which is part of our medical services thing. We do the induction training, and then we do the actual employment and the employment management. Now, it's very important to know or to note that providing staff today is very different to when we started the business. when we started the business, it was providing a staff member with particular skills, and that's where we walked away. Today, the big differentiator comes in the method in which we manage and help the clients manage their staff. We introduce technologies, we introduce artificial intelligence to help them manage their staff and to measure their staff, to see that the productivity is right, and where it's not right, to intervene with training to improve it. And the solution we're providing the client is something that improves his productivity and improves the skills that he has on the floor. So we no longer operate just on providing a staff member. The services that we provide are far more significant than that. And that is, for us, a big competitive advantage, and it's something that we work on continuously. That's where we see that we can create a strong niche in the market. Okay.
Okay, and how competitive is the market in these areas that you've outlined? I can hear your differentiation. Yes. Are there a lot of players?
Yes.
Are they similarly coming up with similar innovations?
So there are competitors in the staffing and outsourcing market. There, at one stage, about 2 years ago, there was something like 500 different staff outsourcing companies. With the contraction in the market and the new legislation that has come in, that has dropped significantly. But there's still a lot of smaller competitors. A lot of them are acquisition targets for ourselves in our acquisition business, or the acquisition part of our business, because we do believe that there's room for consolidating the industry. There is a competition on margin, which is a factor that we have to learn how to handle. And to improve our margin, we bring in more technology, because that is something that we can charge for. And we hope that that will increase the margin. The other areas, training, we are in a particular niche market in the training. Whilst we do training, which other companies do, our focus in our training business is to create a state where the person who is being trained within a period of a year to 18 months can become an earner, as opposed to going to university or to college, where it takes 3 to 5 years before they can commence earning. Our objective is to get them into an earning situation as soon as possible. We focus on the artisan industries, call center industries, industries where people can be trained and can earn money. That is part of our objectives. And we do have competition, obviously, but I think that the solution that we're providing is very important. Incidentally, through training and other initiatives, we also get involved in what is known as the YES program, creating employment. We do a lot of learnerships, which is a very important part of government policy in developing learnerships. We do a significant number of disabled training initiatives, training disabled people, and also advising clients on how to set up their establishment where the workers are working, how to configure it to cope with or to make it easier for the disabled learner to attend and to take his learning or his lessons. Okay, so we feel that that's also a significant contribution. In South Africa, at the moment, there's an obligation to spend, I think it's something like 3% of your payroll on the employment of disabled people. And there are not many companies that can assist industry or corporations in general in doing that kind of training and enabling it. And that is one of our niches.
Right. And government is very, very supportive with tax breaks, etc., and incentives. And They've extended
Yes.
a lot of those programs out, what, for the next 10 years or so?
Yes. So, Brian, the employment tax incentive, which is a very significant part of our business, that has been extended by the government for a period of 10 years.
Yeah.
And we hope to benefit from that. The other incentive, these are both tax and financial incentives.
Yeah.
The other incentive is the learnership under Section 12H, learnership incentives. And those incentives are supposedly going to expire in 2022, but we are very hopeful that this initiative, which has been very successful, that it would continue beyond that, okay, in some form or another. So, you know, we're at the coalface of what the government needs to do in the country in terms of providing healthcare and all the rest of it. Incidentally, healthcare with the new NHI, it might prove to be quite a big opportunity for us. You know, where we have our clinics which can provide that primary service that the government is looking for.
Okay, that's great. And you mentioned that you are, as part of your growth strategy, Africa is a key strategy for expansion of taking all 4 or 5 of your divisions into Africa. Do you want to expand a bit on that, Chris?
Yes. Brian, what you know, our view is that our African neighbours and going higher than that are all in need of the services that we can offer. Our technology is pretty advanced from their point of view, and there is a lack of training. There's a lack of healthcare. There's a lack of proper staffing, and we're finding quite a lot of opportunity going into there. So, for example, in Botswana, we've had major breakthroughs in the last 2 or 3 months, where we've got where we're providing all of our services. And as I said earlier, we're providing some of our services in Namibia, Mauritius, Mozambique. Mozambique is a very interesting area. They've got huge gas fields, and they've been talking about developing them since the 60s, but it has now come out that they actually have started awarding the orders to develop the gas fields to companies in America and the major fuel and gas companies. And those projects are going to start, they actually have started in an embryo way, you know, the preparation of site and all the rest of it. And that area, for the next 10 years, they're hoping to employ 40,000 people in the development and maintenance of those gas fields. And we've really put our hands up to say we're available, and we are going to be part of that.
Okay. Interesting. And how much do you think that might, you know, what's your aspirational kind of growth targets for Africa as a percentage of revenue in the next 5 years or so, do you think?
Well, we've got an aspirational target of 30% of profit to come from Africa over the next 3 years. Okay, but this is aspirational. I'm not being predictive. But I think if we go over the next 5 years, 7 years, I could well imagine that we'll see a much more significant contribution coming from Africa.
Okay. And the risks, I mean, this current wave of apparent xenophobia in South Africa, it's obviously a risk, but what are the other kind of challenges that you're seeing practically out there, and how you're overcoming those?
Well, so I think, first of all, there's the political risk. You know, in the first 6 months, we had an election, and we were all keen on what was going to come out, the economic development, the Ramaphosa's ambitions, and the Patel's new plans. But it seems like they're not able to really give effect to those plans, or that they're very slow in giving effect to those plans. And our staffing outsourcing business can boom substantially should there be a proper infrastructure development program that's so we are working now with hardly any infrastructure development, okay, and that, you know, hopefully it'll change, but we can't give a timeline to it, okay.
Yeah.
So that is one of the bigger risks in the area. The risk of the being a labour broker, and that in our minds has disappeared. And I want to mention that, you know, in South Africa, labour broking was regarded as a negative industry. If you go to Europe and America and many other countries in the world, labour broking or staff outsourcing, which is the correct title for it, is rated on a stock exchange on a PE basis of between 10 and 15.
Yeah.
It's regarded as a high growth industry, okay? And, you know, that's the tune that we want to play.
And turning to other acquisitions, where do you see most opportunity for acquisitions, and what are the sort of criteria you're applying, and where are you looking for acquisitions?
Yes. So, you know, we created 2 years ago, we created a mergers and acquisitions division, and their function is to identify suitable targets to either buy or to, you know, merge activities with. So in the first 2 years, we did some very useful acquisitions in the training business. Now, they are mandated at the moment to find businesses that will be either dolphins, not whales, in each of our clusters, to fulfill the objective that we have to make those clusters financially run at 100 million plus profit. Okay, so that is their broad mandate in terms of the nature of industry. Okay, so that's the one thing. We have other strict financial things that we apply. You know, if you take a look at our group equity, it's around about 450 to 500 million. We say that we have the capacity at this stage to do 500 million worth of acquisitions. They funded 1/3 vendor funding, 1/3 our own funding, and 1/3 bank funding. So that gives us quite a big war chest to do it in. We look at businesses that are cash generative. We also look at businesses where we can absorb their management, because one of the key things in a development program that we've got is having experienced and dynamic management. Okay. So we look at that as one of the factors. We're not in to take huge risks. Most of the acquisitions we do is on a price earnings basis level of about 5, maybe to 6, depending on the situation. We're not looking at fancy PEs of 8 and 9. Acquisitions, we're not using paper at the moment, and there's no intention to use paper as long as our paper is as undervalued as it is. After that, you can see. But we've got enough capacity on a debt basis to do it. Our current debt to equity ratio is very healthy. It's on a 1-to-1 basis. Our cash conversion is good. So our acquisitions, we feel we can do it, and we also feel that we've got the support of our bankers to handle any bigger transactions.
Okay, that's great, and that's a very comprehensive overview. And Ronny, perhaps we could move now to just getting a broad overview of the interim results that you've released this week, and perhaps you can give us an indication of the performance of each of the divisions and just some relative contributions from those to the whole.
Yes. So what I'd like to do, Brian, at this stage, I'd like to introduce Willie van Wyk, FD, he's the man with the figures, and I'd like him just to intervene and give us a bit of an indication of how we went in the first 6 months on a broad scale. Billy? Yeah.
Okay, thank you. Sorry, I can't help myself. I call him Mr. K. So internally, we all call Ronny Katz Mr. K, and it's what we call it. So just to introduce myself, I joined the group in 2008. So I've been around for 11 years. I joined after listing. And I was more or less born when Workforce was started. Actually just a year before that. But in spite of my youth, I've had 11 years of experience in this business, and it's been quite a ride. Just in terms of results, I think we published our results in fair detail, so you're welcome to go through that. I think just talking around the drivers of the results for the last 6 months, and then what will drive it going forward, if that's okay, Brian.
Yes, that's perfect.
Okay, so I think just in terms of context, we always like to quote our compound annual growth rates, and then up till last year, also published on our website. Since 2014, we've grown EBITDA by compound annual growth rate of 18%. Profit before tax 20%, and then headline earnings a little bit low at 15% as well. And then in terms of the drivers of that would be obviously we've had a long history of organic growth, but there's some acquisitive growth in there as well. And then in terms of our segments, your staffing and outsourcing. This last 6 months, also as we've said in our presentations, the big drivers were the solar projects that's been delayed. Those are high margin businesses, which haven't been there for the last 6 months to the extent that it's been in the past, and that explains some of the lower margins as well. And then the employment tax incentive, which Mr. Case talked about, has given a lower contribution, and then economic factors, which were also mentioned. In terms of what will drive those results going forward, some of those projects have already been unlocked, and hopefully more of them coming on board. Your process outsourcing initiative, which talks to a little bit of a different business model, which was also mentioned. And then our geographical expansions in terms of Africa, going to Chile, the bigger projects into Africa will drive that. And obviously we've got a very strong management team, and we believe they will drive growth even further. That is that for staffing and outsourcing. Training division, really they gained a lot of momentum, especially. Well, it's been building over some years, but if you look at last year's results, they really went strong momentum, and really our strong results continue to that momentum. And then also the acquisition, which was made June last year, 2018, also gave us a little bit of a boost to the extent of about 2.8 million rand. But the rest really came from our current businesses. Yes, that's right. And then financial services. Financial services really had a bit of a consolidation period, really growing, gearing up. If you look at the operating expenses increase, really gearing up for the expansion hopefully to come, and that talks to also Mr. K's discussion around the Botswana growth, also insurance business, some new contracts coming in, and hopefully we can capitalize. And then also thirdly, the collection business as well, building and expanding on our collection business. And then healthcare is also a story that really built up on last year. They invested a lot in human capital and infrastructure last year, and you're seeing those bearing fruit now. Also a lot more, some contracts gained, and also some new business initiatives. And then really what will drive that going forward, we believe once again, to what Mr. K said, there's some real momentum in that business going forward. And yeah, and then that really talks to our 4 clusters. And then I think just mentioning as well, emphasizing as well, cash flow. And our cash flow is really, really a big priority in the group, because that is what enables our acquisition strategy, and obviously that's also what makes the group sustainable. And also, I think something that I'm quite proud of, if you look at our acquisitions over the last 3 years, about 5 or 6 of them, and the fact that we've been able to do that mostly out of cash earnings, obviously incurring some debt along the way. But if you're look at our interest cover ratios, it's all been fairly consistent, and in fact improving over the years. So yeah, that is my story. Hopefully not making any predictions, Brian.
Okay. Thanks very much, really. Ronny, anything to add about how you see the next 18 months or so, given the economic climate, with your growth aspirations, etc., without forecast per se?
Without forecast, I think if you take your base of last year's earnings, I think what we have already in our pocket is something that would equal what we earned last year, with a slight improvement over the year. Whereas in the first 6 months there was a slight deterioration in the earnings. We feel that we've got a solid base going forward.
Okay, great. Okay, excellent.
Yeah. Yes, thank you.
Just to mention to the balance of the participants out there, if you'd like to ask any questions, I think we're going to move on to questions now. So yes, if you can just write those questions in the question section. I do have a few questions here. So, Ronny, a question for you. Where do you see micro-lending going in the SME sector in the next few years?
The micro-lending, as far as we're concerned, is very regulated, and from our point of view, we're very happy with the regulation. In fact, the more regulation, the better, because it's very important that the micro-lending be done on a basis that you don't overlend to people, you don't put people into distress, and also that there are limits on the margins that you make there. So, when we started the micro-lending, it was in the days when you paid your staff by check. And we noticed that our contractor staff weren't able, because they weren't bankable, to cash the checks, and they would go to lenders, and the lender would give them half of the check and keep half for themselves. And we decided to really try and facilitate a much easier system for the employees or the contractors to get their full return. So we feel that the rules that have recently been introduced, a lot of them, we feel that they're beneficial to both parties, because overlending is just as risky for the borrower or for the lender as it is for the borrower, because at the end of the day, you overlend, you can't collect. So those constraints we feel are very productive for us. Okay. Our micro-lending is very of a short-term nature. Probably our average loan is around about 2,000 Rand. Our average period is about 6 months. Okay. On the volume of the number of people, we've got a very good technological system to manage our lending and to manage the collection of the lending, and we're happy with that. There could come a time where we expand that to the general market, but it's not what we are inclined to do at the moment.
So does this mainly go into your captive base of 35,000 people on the payroll?
Only into our captive base.
Okay.
We at this stage don't lend outside of that.
Okay.
Other than other than the new initiative which we have now in Botswana, where we're lending to government employees on a government payroll deduction. Okay, so there the profile of our lender is different to the profile over here.
Okay.
Yeah.
And then there's a question now on someone just asking, what is the of your growth? How much comes from organic growth and how much from acquisitions? And I would guess that's kind of more in a normalized environment.
Yes. Well, in the year that we've or the 6 months we've just had, all of it was organic, excepting for 2 million rand, which came from an acquisition in Dyna Training. Other than that, it was all organic growth.
Right.
Okay.
And do you
going forward, it's very difficult to tell.
Yeah, I guess. Yeah.
Sorry?
I guess it's difficult to forecast, or you haven't really got a target of how much you would like to see as the balance between the two.
No, it's very difficult because you know, they both grow at different rates, and it's very difficult to predict which one is going to contribute more. So we look at the overall result then.
Okay, and then someone is saying, so what's it going to take to get the discount to NAV to reduce?
Okay, so my view is the reason that the NAV is so low because of the image of labour broking. We first of all, we feel that image is turning. There's not nearly as much noise now as there was a year ago. Second of all, our company has transformed itself. If you take a look at the PE ratios on a training company, that is, you're talking about at the 10 level. So the more that our diversifications contribute to our earnings, the more life we will see in our share price. Our basic philosophy at this stage on the share price is that provided we provide good earnings of a solid nature in growth industries, our earnings, our share price will be recognized and will go up. Okay, there's not much we can do in the market to do it. We can do it within the businesses that we develop.
Yeah, and I'd really echo that. I'd say we're in a secular downturn towards small cap stocks. Yes. And when the sentiment changes, and we'll see a huge change very quickly.
Yes, that's what our feeling is as well.
Okay, gentlemen, I'd like to just say thank you very much once again to our guests today, Ronny Katz and Billy van Wyk. Thank you very much. I'd like to remind you all that the research is available on the website, the Standard Bank website, and you can contact ourselves at Merchant Tech if you have any further queries. Look out for our report on workforce, which will be out in the next couple of weeks. And I'd also like you just to acquaint yourself with the disclaimer around the information that has been presented throughout this webinar, in that, you know, as attractive as opportunities are, you need to do your own research, and please refer to the disclaimer on the websites. Failing that, I'd like to just hand over for a final word from the CEO of Workforce, Ronny Katz, and to thank you.
All right, I'd like to thank you, Brian, and to any listeners here, thanks for the patience and listening to us. If there are any direct queries you've got, our phone lines are always open. You can speak to Billy van Wyk, or you can speak to myself, or to our marketing department, Jason Boone. We welcome an interaction. Thank you very much, and thanks very much, Brian.
Thanks very much. Yes, thanks.
Okay, thanks. Bye.